Thank you for joining everyone today. Appreciate it. Sorry about the video issues. But
No worries.
yeah, we got a great panel, like she said, and um, just everybody's on. Great. I see everyone. Um, and we're going to go individually with some guys, and they'll, of course, will chime in when they'd like on whichever topic's appropriate. But some of these topics we have and questions are directed specifically to one of our panelists, so we'll kind of go that route. And starting, I guess, with Dwayne. Dwayne, as a, we got most of our audience, CFO, controller, treasurer type folks. Would you suggest that folks just continuously engage with our investor lender, community when they're planning a capital raise? And if they are planning, what would you suggest? How far out someone would suggest starting in the engagement process?
Sure. Thanks, John, and thanks to everybody on the CFO Leadership Council for allowing us to participate in this presentation or this panel today. On your questions, I think it's always good for for any company to be engaging with potential investors, whether you need those investors today or not. I think both for your benefit and for the benefit of the investor, having that pre-existing relationship well before you need capital is going to be a positive. It gives you as the company the chance to meet these investors and see who you think is the best fit for you and your company, but it also allows you to start educating those investors on your company and your team, so they get additional comfort about who you are and what you do long before you go to them and ask them to provide some capital to your business. So I think it's important for you to always be looking at engaging with a select group of investors, and I would encourage companies to do that across the capital structure, not just senior lenders, but also junior capital and potential equity investors, because you never know in the future what you might need from a capital support standpoint. So I think that's very important to always be doing as an operating company and as a management team. On the timing, I would say from my standpoint, once you've decided that you need to go out or you want to go out and raise some capital, I think the timing is really going to be different based upon what type of capital you're looking to raise. If it's junior capital, whether it's kind of subordinated debt, mezzanine debt, or equity, I think you need to leave a longer time frame. I'd say that's going to be somewhere kind of 1 to 3 months, all dependent upon what type of transaction the company is seeking to complete. I think if it's a more traditional commercial bank or senior bank type financing, whether that's a net working capital need or CapEx or something that's more just a growth capital need where the capital is staying in the business, I think that time frame can be much shorter. But I think the time frame is really going to be dependent upon the type of capital and what type of transaction the company is looking to try and complete.
Got it. Okay, thank you. And switching over to Colt for a minute, when we talk about the U.S. economy, both here locally, Houston area, and around, and maybe the Southwest market that a lot of people deal in, but maybe even on a national basis, what are you seeing right now in terms of that, and how this affects kind of the financing and relation to that kind of? Do you think that's going to impact, capital raising, the debt and equity side? Of course, we got new administration potentially coming in, that kind of thing. So, please.
Sure. Yeah. No, thank you. And it's great to be here this morning. So appreciate the opportunity. Yeah, I think surprisingly, the economy, seems to be doing, pretty well. I mean, certainly better than I think a lot of us expected in the late March, April, and May timeframe. I know at Gulfstar, we were typically working on about 50 or so transactions at any point in time. Middle of March, we put all of those on hold, really to assess, how each company performed and what dynamics, we would see in the marketplace. And candidly, we expected that the debt markets would cease to function, and we saw a lot of the, pretty much every company that we were involved with, or that was owned by private equity groups, ended up drawing down on the revolvers and preserving liquidity, and things kind of did freeze up there for a couple of months. Come about June, I think people started to sift through the rubble and say, okay, well, we've got this company over here that's performing well, and this company over here, has continued to operate, and they're okay. and yet we've got other companies that are struggling. So if you look at the 50 or so companies that we're engaged by right now, we're back in the market with a bunch of them. And I would say that for those that haven't been really decimated by the pandemic, frankly, most of them are doing quite well. They're hiring. They're continuing to have kind of employee availability issues, and we're seeing good receptivity in the marketplace, from a financing perspective. So
Yeah.
Capital is available, and I think the economy in general is doing surprisingly well. There's certain pockets of it that continue to struggle. Energy, disappointingly, is continues to be a tough spot in the economy, and really there continues to be a lack of capital allocation towards that sector, and really the likes of which I've never seen in my career. But by and large, I think the availability of investment capital is reasonably similar to that which it was kind of pre-COVID, which is not a real positive development, and certainly not where we expected the market to be.
Mm-hmm. All right, thank you, Colt. Bill, moving on to you. On financing strategies, some of them have evolved, some of them obviously stay the same, but do you feel like that those have really changed over the last few years? And what would you say if you're seeing more, less, or about the same when it comes to public markets, whether it's equity or debt? I know your company's mostly in the debt side, but strategic financial, some of those, if you want to comment some of that on the financing strategy market.
Sure. Thanks, John. And again, it's a pleasure to be here. I think it's very much a mixed bag. And like Colt said, on the energy side, it's really a tough environment if you're in that space. The bankers that we talk to are very hungry for non-energy names. So if your company can be classified as industrial or general commercial and not energy, that's a very good thing. And it just seems to be very, very competitive for those types of transactions. But if your company's struggling with, financial covenant compliance, like a traditional debt service coverage, for example, it looks like the banks are leaning on liquidity covenants as an interim measure. I think what they're saying is we want to make sure that the companies could get on the other side of the pandemic. And so we've seen banks suspend, debt service coverage compliance until mid-2021, until things shake out. And but as long as they're not worried about liquidity. On the other hand, if a company is worried about covenant compliance and liquidity, then the banks, I think, are less understanding about that. And that's where non-bank lenders can be very helpful. And we're seeing on the non-bank side that's very competitive there as well. So we're very busy, and those companies that do have or are concerned about liquidity, we're seeing them monetizing certain assets to make sure that they have enough liquidity to get through there. They're leveraging real estate where they can, or other assets, to make sure that they've got a significant borrowing base and liquidity available. So I think, John, in summary, credit is still available, but you may have to get it out of a different pocket than you have before. And you really need to know where your company is positioned, because it is a different time and banks may be reacting differently to financing requests than they have in the past.
Okay, got it. Shifting back, Dwayne, when it comes to evaluation on a business enterprise, there's various types, of course. Suggestions there, I guess, on the various kinds that you're seeing when it comes to businesses, maybe in some of this, economic times, if they're a little bit different, and if you do see any difference in terms or valuations, between in the different geographic areas across the country? Is, you think the Southwest values a business different than West Coast or East Coast?
Yeah, I would say when you kind of look at the market, broadly, I think, Colt touched on this a little bit earlier. I think the market has covered significantly, both in terms of valuated, whether it's a Texas-based firm like Main Street, or if it's a East Coast, West Coast firm. I don't think you see those firms take different approaches to valuation or structure. There are some groups like ours that will have unique strategies that will be different than others, but in terms of underwriting a business from a diligence standpoint and from a valuation standpoint, I think you'll see them largely be very consistent. They're underwriting to the same types of metrics, whether it's cash flow or revenue or some other financial metric, and generally underwriting the same key business points with revenues and customers and all the other important parts of a business that make them makes a business value and makes it valuable, and kind of has different views from one business to the next. So I don't think you see differences in how investors approach things based upon where they're located from a geographic standpoint. I would say that when you look at how investors view companies based upon where the company is located, I think that's where you see bigger differences. And I think that's probably been the case for the last couple of years. But I think with the impacts of COVID, I think the way investors are viewing companies, say in Texas, where impacts from COVID have been less significant than you may see in California or other places on the East Coast. I do think that plays a bigger part in valuation structure and terms today than it would have a year ago, just because you've seen what's happened in different geographic areas in response to the COVID-19 pandemic.
Yeah, Dwayne, I'll just add. I agree with you 100%. I think that it's very much more driven by company performance and investment strategy in terms of the types of businesses that that folks invest and lend to, than it is the location of their own firm. And so I think functionally you've got it's been easier for companies outside of severely impacted markets to recover more quickly and continue to perform. And so there's perhaps been some kind of self-selection element to that in terms of making companies in a certain geography more or less attractive. But I think it really doesn't have anything to do with the actual geography, and I think it has something to do with their ability to operate successfully in this marketplace. There's I think the market in general has been pretty creative and pretty nimble, getting back to how they conduct diligence and being able to conduct a lot of diligence virtually. And so we were worried about travel and felt like deal making may be a bit more regionalized because of travel limitations. But I think the emphasis on virtual diligence and some selective travel at certain key points in a transaction, frankly, the market's kind of been able to do deals in all regions. We're closing a deal next week, knock on wood, that the sellers in Phoenix and the buyer, the private equity group is in Boston, and the sub-debt group is in Birmingham, and the senior lender is in Arizona. And so that's happening kind of obviously across the continent, and we're the diligence and the negotiations and everything has happened largely virtually. So,
Colt, would you think though, if a deal like that, say, is heavy in real estate, let's say, that could make some difference geography wise, right? If they have their headquarters is 200,000 square foot facility and it's in Phoenix versus 50,000 square feet or something, and
right,
they have a bunch of locations. That's I'm guessing that's why when that could cause an effect on evaluation if it's a heavy real estate intensive deal.
Yeah. No, I think,
yeah.
I think I think you've got to understand the type of capital raise and that that is at play in the transaction. And so, but I still think that people are being, I think what we've seen is people are being pretty thoughtful about how they conduct diligence. And so to the extent that you've got a multi-location, business, you want to make sure that, the diligence, if you need, boots on the ground in a bunch of different local markets, you need to make sure that your diligence providers have, a national or regional footprint that allows them to minimize travel and to, kind of respond and visit site locations in a local market and do an assessment, using local market resources or regional market resources rather than, having, a group, crisscross the country, on flights.
Sure.
So
Yeah. Colt's still staying on you and moving on here. Upon a planned or unplanned liquidity event, what would you say are some forms of exits that people can think about? How should a company think about even strategic on those exits, being a strategic M&A like you're involved in heavily, financial IPOs, et cetera?
Sure. So, I think, it's hard to comment on the IPO just because it's not a part of our strategy. I guess generally speaking, what we've seen over the last, really over my career, is that the bar to really do a true public offering. The market size for companies today, you need to be a pretty sizable business. And you also really need to have a reason to be public from an access to capital perspective, because the regulatory and kind of liability associated with being the regulatory dynamics, the disclosure issues, and just the sheer cost of being public has gone up so considerably over the last few decades that you need to be big enough to be public and have the benefit of being public. And Dwayne, running a public company, Dwayne could probably offer some commentary on that. In the private markets, we're big believers that there's great value in having and preserving optionality. And so, we think that a full understanding of the available financing options, is and transactional options is a pretty important part of successfully executing a deal. And so, for that, what I mean is, it's our advice that to the extent that you're looking for some sort of liquidity transaction, that you ought to consider, a minority financing option. You ought to look at a majority recap, and you ought to look at an outright sale to a strategic buyer. And you ought to do all those things on a parallel path. And that way, you've got the benefit of understanding and assessing the entire market, and you can make an informed decision with the benefit of, the cards face up on the table in front of you, and not have to wonder which option is best. You can see it and feel it and assess who would be your partner, what life would be like after the transaction, et cetera. So that's how we think about the world.
And Colt, I'd add on to that. I agree with everything you said, and I definitely, when you look at public companies in today's environment, the smaller the company is, the more difficult it is to justify being public, because the cost of being public, whether it's accounting, legal, or otherwise, have significant. And I think in today's environment, those costs just continue to increase as opposed to decreasing. And I think if the goal of a company's ownership group and its management team is to get some liquidity, but preserve a lot of the upside for future value creation by completing an IPO as opposed to a full sale or exit of a business. I do think what Cole said earlier about minority transactions can really achieve a lot of the same benefits there, but allow that management team and its existing equity ownership group to maintain control of what happens in the future, and really can maintain the same control they had about the planned strategic activities and execution of what happens in the future in a private company context much better than they can kind of in the public markets.
Yeah, I mean, candidly, the private markets have gotten, just as the public markets have grown in size and the requirements to access those markets have grown in size, the private markets, both on the debt side and the equity side, have also grown, right? So,
Mhm.
I mean, you can, a mid-sized company, candidly, they could do a deal and then 4 years later do a deal with another private equity group. And I mean, there's, you can get to, do tens of billions of dollars worth of deals and still be a private company, and have plenty of access to capital, given the structure of the private equity markets.
Okay.
Hey,
Thank
John,
you.
we've got a question.
All right, go ahead.
So this particular CFO's company has aggressive growth goals for 2021. We currently have cash plus a credit line with our bank, but it would run out eventually. At what point should I start considering any additional capital with new investors? Is there a KPI or metrics that would trigger starting the conversation with investors?
I'll take a stab at that, and I'll let Bill and Colt add on. I would say it's hard to give an answer to that without knowing what the future capital needs are. But I think for all businesses, maintaining an active dialogue with your existing lenders and understanding where they're at today, but more importantly, where they expect to be in 3, 6, and 12 months in the future would be the place I'd start, and really having open dialogue with them about what your needs are and what the expected outcome from those additional capital investments, what that outcome is expected to be, and get a read from them, and really try to understand what is their appetite for providing that capital. And as soon as you get a view, whether it's a definitive view or if it's just an indication that they may not be willing to provide that, I would encourage the company to start looking at other sources of capital, whether it's other senior lenders or if it's junior debt or equity, because as I said earlier, the further you go down the capital structure in terms of the financing need, the longer it's likely to take the company to achieve that financing transaction.
Yeah, I would agree with that. I mean, I would, the simple rule of thumb for me is I would start before you need it. I mean, be active in the process and before you actually need the capital, because if you're waiting until, you have an immediate capital need, upon you, it's tough to get a deal done and kind of retain the proper competitive dynamics to optimize that outcome. And so, I'll give you a point of reference. I mean, if we're going to go raise capital for, a business or even sell a business, I mean, frankly, there's, probably a 30 to 60 day preparatory period before we would even take a company to the market, because you want to be well prepared with your information and have all of your data in the right manner. And to Dwayne's point, the more equity oriented that financing becomes, the level of scrutiny and the granularity of the information that is going to be required, kind of grows exponentially. And so you want to make sure that you are fully prepared before you go and engage with those financing sources. So, really, there's a month to 2 months of preparatory activities before you would even engage, in a process, and then the process itself, typically takes, for a debt financing, it depends on the nature of it, but it might take 45 days. An equity financing, probably takes closer to 90 days from the point in time that you actually go to the market and engage in discussions. So hopefully.
John, I would add on to that if you're projecting that you're running out of cash in 2021, I would say that, the time to start conversations is really now, because the truth is everything's changed. So the partners that you've dealt with in the past are still trying to figure out where the market is. If it's a bank, the lenders and the credit guys are trying to figure out where the bank stands with respect to different types of industries and so forth. So if you're projecting that, that cash need and in early or mid 2021. I'd say you probably ought to start talking about it right now.
Yeah, I would agree with that.
Great, great advice. And just as expected, and I'm so glad to see this, there's some questions in the chat section. Everyone feel free to use that as asking questions, and also feel free to answer some of your fellow CFOs questions. But here's another question. It's good. When assessing deals, how are you treating PPP loans and the challenges that businesses are facing in their ability to apply and receive forgiveness?
Yep. I'll jump in here because I'm doing a transaction right now that we've got several in house that are kind of in the different stages of closing at the moment. But really what we're seeing that has become market and kind of best practice is that if a PPP loan has not yet been forgiven, then really what I think buyers are expecting is that you escrow. You're going to close the transaction, and a portion of the proceeds are going to be set aside in an escrow with the PPP lender and pending forgiveness. Okay, so this transaction that we've got closing in Arizona next week, that company they've actually got two PPP loans because they had two different legal entities, one in Arizona and one in Colorado. And so that company's PPP lender actually has not opened their portal yet. Okay. And so they are not able to even start the process of applying for forgiveness. And so we've got an escrow that will be funded at closing for the total amount of the PPP loan. And then we've got post-closing covenants injected into the structure of the deal, whereby the buyer has to kind of facilitate and ensure that when that portal opens up, they will go through the application process. Now, as it happens, this is a private equity deal. And so, my client is going to continue to be the CEO of the business, so he'll be intimately engaged with it. But there's a post-closing covenant that NewCo going to navigate that forgiveness process when it's available. And then to the extent that the loan is forgiven, those funds will revert to the sellers. To the extent that it is not forgiven or some portion of it's not forgiven, that money will be used to repay the PPP. And so that has been a pretty seamless process, frankly. One that I was concerned about, but it's been navigable. So I don't know, Bill or Dwayne, what you guys are seeing.
Yeah, I would I'd say you're exactly right about that, Colt. The two things that we're seeing with the government related loans, there's the PPP loans, but then also these EIDL loans. And if you have those on the PPP side, we're not seeing the government file liens against assets. They're designed to be unsecured. But we were closing a transaction earlier this week and learned that the SBA actually had filed a lien against the company's assets. But it turned out it was related to the EIDL loan and not the PPP side. But it caused a delay. And fortunately, we have a good line into the decision makers there. We were able to get it resolved. It did hold up the closing for 2 days. And we simply reserved out the amount of financing needed to repay the EIDL loan, which is typically smaller than the PPP side. But as a secured lender, for the most part, we're not worried about the PPP side because we believe that that's probably going to be resolved, if they've done everything the proper way.
The only other thing I'd add, I agree 100% with what Colt and Bill both said, but the triple P process guidance, has been limited and in a lot of situations kind of a moving target. But I do think this is an area that, I can't remember if it was a month or two ago, that they did put out pretty clear guidance. And as Colt, outlined, the escrow process with the triple P lender is very well documented in terms of how, how it should be handled if there's a change of control. And change of control, I think in this situation or this circumstance is not 50%. I want to say it's a 20% change of control from an equity ownership standpoint. But I do think that the guidance that's out there in the triple P loan landscape is pretty clear, at least as it relates to this this part of the program.
Yeah, just one other thing I would, if you're considering leveraging assets, just make sure that if the government has placed a lien on your assets, if you either have a PPP or an EIDL loan.
Gentlemen, I'm not sure if you answered this already. This is a good question. Has the outstanding PPP loan impacted the valuation of businesses?
I'll take a stab at that. I'd say it hasn't. I mean, when an investor, at least on the equity side, is looking at a business and he's underwriting the company from a valuation standpoint, he not just with triple P loans, but he really is ignoring the existing capital structure to begin with. He's really looking at what is the company worth, and then he's gonna take that valuation and apply it to the company's existing capital structure. And the existence of triple P loans or not having a triple P loan, it really has no value on that when you look at the overall valuation of the business. As Cole said, it absolutely can impact the amount of cash that's available for the existing owners and the sellers of that business when you go through the waterfall of how that that enterprise value gets applied to the different components of the capital structure, and at the end of the capital structure, what ends up going to the equity owners. But it does not have an impact, at least from my perspective, on the overall enterprise value of a business.
Yeah, I agree with that. No impact on enterprise value. Could have a temporary impact on shareholder value. But to the extent that you did everything correctly and utilized the funds and kept proper record keeping and all that sort of thing, then that should be resolved once you've got forgiveness. And it's a surprisingly navigable process, frankly. So.
Excellent. That concludes my Q&A. Keep them coming, though. If you have a question that you want me to ask and remain anonymous, feel free to direct the question to me directly. John, I'll turn it back over to you.
All right, great. So, Bill, how would you describe the current financing market environment when we're talking about, COVID and pandemic stuff? So it obviously was in kind of a going well, I guess, at least from the big stock market side, but not necessarily certain industries like you've described. But what would be the difference of, that early days of the pandemic, and then now we're kind of going to a back to maybe an old normal, but different environment, of course, in 2021?
Yeah, sure, John. I say if you go back to the first quarter, business was very good for both banks and non-banks. Very robust competition, and record quarters for lenders, and it was just a very good time. And then just the shock and awe of the downturn paralyzed everything. And so working capital for companies in that March through, say, July timeframe probably contracted about 30 to 40%, depending on the industries that you serve. So initially, we thought that companies would be flocking to non-bank lenders like us, but that really didn't happen. Business didn't really return. Our pipelines didn't return until, I'd say, early August, September. And I think part of that was, banks were just frozen in place. So borrowers weren't sure what the banks were going to do. And but it also had to do with the PPP and EIDL loans that were made available by the government. Companies were very interested to see, how the government would help them before they pursued, different financing alternatives. Then the third leg, this Main Street lending program, I've heard mixed reviews on that. It doesn't seem to be that popular with banks. And so business is returning now to us. And I think just regular bank lending, because it looks like, the Main Street lending program, which I think expired either Monday of this week or Monday of last week. So it looks like they're going back to more traditional sources. The problem is that the numbers for companies have suffered. So as I mentioned before, how does a bank react to a financing request when a traditional covenant cannot be met? and the biggest covenant that banks rely on is debt service coverage. And so we are seeing in some cases, a return to a liquidity covenant just so they can get to the other side. But every bank is different. Every banker is different. But if you're growing, and we're seeing these companies grow now, I like the quote, it's like liquidity is like oxygen. It's not okay to have it 99% of the time. You need it when you need it. And so, so if a bank tells you that, look, we need to wait and see how the first quarter looks or the second quarter, well, that's not good enough for a company that needs liquidity now to meet their needs. So I think it's a particularly good environment for asset-based lenders like us who are not focused on debt service coverage covenants. We might have a covenant like a net worth covenant or something like that, but it's a very good time for non-traditional asset-based lenders like us is how I would describe that.
Okay, good deal. Dwayne, switching over to you a second. Would you say that Main Street in your group is seeing an alternative deal structure environment, such as increased use of seller notes, earnouts? We talked about a little bit of minority deals earlier. If you could comment on that.
Yeah, I think when you look at the market, and I think as we've all touched on in our previous comments, I think the market continues to move back to where it was pre-COVID. I do think over the last couple of months as investors, including Main Street, continued to execute on deals. You were seeing more use of alternative structures like a seller note or an earnout in certain situations where there was a desire to complete a transaction at a difference in opinion on valuation or other parts of the transaction. So I do think that had happened quite a bit over the last 6 or 9 months, but I do think that has is continuing to go away, and you're getting back to what are more traditional and more normal structures and valuations. I do think that when you look at on the seller side, throughout the duration of the pandemic, and we continue to see it today, I think the driver on alternative structures is less on the investor side and more on the existing company or owner side. So if they continue to have the view that they may not fully realize the valuation of the business in today's environment for whatever reason, because their business was impacted by COVID or the outlook is still a little bit uncertain, I do think that's where you're seeing existing companies and owners pursue a minority transaction because they have the view that that they can continue to get a significant amount of liquidity, something that's going to approach a number that is probably, depending upon the transaction, 75% of a change of control transaction. So they can achieve a significant amount of liquidity, but as we said earlier, continue to maintain, a lot of the upside going forward. And more importantly for the company and its owners and its management team, as I touched on earlier, they get the opportunity or the benefit of maintaining control, which is what a lot of business owners really demand if they're not going to get, the full liquidity or the full valuation that they expect their business is worth.
Got it. Colt, I was just curious, you've got a few deals in the marketplace. Are you seeing these deal structures change very much versus what you're used to normally in terms of more, equity contribution, et cetera?
Yeah, no, I think there are examples of that, but by and large, and I could touch on a couple of those, but by and large, I'd say that, the market, is kind of, working in kind of a normal course of business, today. I think, it would have been reasonable to assume that, we would see more in the way of earnouts and seller notes. I think that, because, when you have financing uncertainty, those are kind of elements, and business continuity uncertainty, those are kind of elements of a transaction that get injected to bridge what may be a valuation gap. Candidly, we're not really seeing those in today's market. We're seeing normal deal structures. I think we just got bids in yesterday on another transaction that, we are in the market with. And, they're, 80%, from private equity groups, because frankly, the private equity groups have been more nimble getting back, they've been more nimble in this market, getting back to, doing deals than I think strategic buyers have.
Right.
And so, but the structures that are being proposed in that deal are normal structures. I do think that you're likely to see I think the market overall, you're likely to see a bit more frequent use of subordinated debt in kind of today's market and the market perhaps for 21 than we've seen in the last handful of years. I think, what we've seen over the last several years is that, the equity groups would put a bit more capital in, the senior groups would, as long as that there was more equity capital put in, they'd give a little bit more debt, straight up senior financing. And really, it was the exception that we saw a deal being funded, partially with sub debt kind of sitting between the equity and the senior. Today, I think, and going forward, I think you will see kind of a bit more frequent use of sub debt in the market. But other than that, I really haven't seen, much in the way of, change structures.
Okay, fair enough. Thank you. Bill, switching over to you. Have you seen, you think, a shift of lenders' focus on, stronger collateral coverage in deals, when it comes to the types of financing you guys work on?
Yes, we have, John. And so I guess I'd describe it this way. If you're with a traditional cash flow lender and your leverage is between 2 and 3 times, you might have a 3.5 or 4 times leverage covenant, and your cash flow goes away, well, then that covenant doesn't work anymore. And so especially if you need, access to additional funds, then what do you do when that traditional covenant doesn't work anymore? And so that's when, as I mentioned before, turning to an asset-based lender has become an access to liquidity that is extremely important to companies. I mentioned real estate before, so companies are re-leveraging real estate, equipment also at the same time, and so those are good sources of liquidity for companies. The other thing I'd mention though is that some companies, and I have a long history in the energy service side, excuse me, and they're finding that banks may not be the right home for certain types of very cyclical industries. And so that's a tough message to hear from your bank because you've relied on them for a long time. And look, I was in banking for 30 years and I get it. But if you have liquidity issues and you have negative debt service coverage, just knowing how banks work, I mean, that's an express ticket to the workout group. And once you get into workout, it's easy to get in sometimes if you stumble, but it's extremely difficult to get out because they want to make sure that business has returned, that it's stable and so forth. So, again, back to energy service, that business is very cyclical. The business will return before your numbers have returned. So you can't demonstrate that, with your financials that the business has returned. You can talk about the new orders you're getting, you can talk about the new jobs, but until the bank sees evidence that you're going to be in compliance, it's going to be hard to access capital from that traditional source. So I think you need to know if you're the right fit for a bank. And so I would just say that if you're in one of these cyclical industries, begin talking to your banker very early to make sure that it's still the right fit for the bank. Because it's frustrating for companies. We hear it all the time. Like, hey, business is returning, but we can't, we can't get an answer on a covenant relief package or something like that. So so again, it's where you're positioned currently with your bank, and then in what industry that you're in.
Mm-hmm. I know we touched on this a bit earlier, but if you had any expanded comments, Colt, on buyers or lenders that are dealing with COVID-related adjustments. Maybe you got some deals you said are in closing stages. Are those expenses seeming to curtail off a bit, and kind of how are you guys handling them?
Yeah, I think, well, as an investment banker, we certainly love our add backs. And so if we can add it back, we want to add it back for sure. So I think, I think the COVID add back is perhaps less of an add back and more of a communication about the impact of trying to isolate the impact of COVID and show both sides of, well, hopefully both sides of a recovery of a curve, right? So you see, I think it's getting somebody to buy into kind of a return to normalized cash flows, and the continuity of those normalized cash flows is dependent upon being able to see, not only the slope down to the extent that the business was impacted, but also a stabilization and then a slope up. Okay. And so I think if you can see both sides of the curve, down and then stabilize and then back up, then I think you can point people towards, a normalized continuity of cash flows. And in the absence of that, to the extent that the company hasn't yet recovered, and the curve hasn't trended up, it's frankly hard to communicate effectively to a buyer or or lenders that we've come across that aren't just, if they're asset based, then they're looking at different metrics, as Bill's kind of alluded to. And so, but if it's cash flow based deal, it's hard to get the benefit of a anticipated recovery without having that recovery seen in the numbers. And so I don't know, Dwayne, what I don't know whether you guys are buying off on COVID adjustments, but those are my thoughts.
Okay. I'm actually curious. We talked a little bit about the PPP forgiveness. I've got something similar situation on this. And Cole, may be more applicable for you, but certainly Dwayne or Bill. But when the company gets the approval for PPP, right? So it's coming back onto their, they've been holding it like in a separate account or something. Now it's canceled on their balance sheet. Are they're going to count some groups count that as other income, and it's, that they got a big windfall in like the month of November, let's say, or I don't know. It seems like it might fall more as an add back, as one of those non-recurring, income items for adjusted EBITDA. Where are you guys seeing that fall?
Yeah. I think that
it's non-GAAP adjustment. So sorry, go ahead.
Yeah, no. I agree. I think that the income effect of any forgiveness is, somebody that's doing a quality of earnings on a business or looking at the company to value that business, they're going to look right through that and not, there should be no kind of income effect related to the PPP treatment. Really, it's ultimately, the expenses, to be properly accounted for, the expenses that you utilize those funds for should continue to be, flown through the income statement. Although that there will be a difference, as I think everyone knows, between tax and book, related to those expenses, the cash receipt and return and / forgiveness of that shouldn't, to the extent that there's an income statement effect, people are going to undo that and just focus on the balance sheet.
And I might add onto that, Colt. I think when you look at it, the triple P income that would otherwise be coming through the company's income statement, that is likely the same types of items that you're treating as an add back. So you're not going to get it twice. You're not going to get it as a COVID add back to EBITDA, and then also get the triple P forgiveness as income. You're not going to get to double dip on it. And you kind of go Colt's earlier comments. I'll I've agreed with Colt on a lot of things today, and I will absolutely agree that investment bankers love to push add backs. I think the key for any business and for the the bankers and intermediaries that are helping them out, I think when you look at the COVID add backs, the more your investor understands your business in that industry, the more likely that investor is to give you credit for the add back. And I can go back to some of the previous comments we've all made. If you're looking at a transaction, whether it's a financing or some other liquidity event, when you're going to those potential investors, the more that knowledge they have specifically on your business and your industry, the more likely they're able to to give you the benefit of those add backs.
Well, won't some groups argue that I've had this argument already, but so I know this firsthand. But they'll argue that, well, the PPP, that was supposed to account for missed business income and such. So therefore, we should treat it as regular income. And it's, in other words, that's the argument. At least maybe an add back investment bank will make as well, but the company certainly. I've had this discussion with the CFO.
I think that's right, but that's if Colt and Gold Star.
Day for technical difficulties for sure.
Yeah, I'm sorry, Dwayne. I think.
Okay, go ahead, Dwayne. We lost you right at the beginning.
Can you guys hear me?
Now we can. Yeah.
Yeah. Sorry about that. What I was saying is that it goes back to what Colt was saying earlier. They're going to be pushing for COVID add backs. So I look at it to if you've got someone like Gold Star and Colt involved, they're already going to have accounted for lost revenue, kind of extra expense and those types of items in their add backs.
Mm-hmm.
That's where I think it's it would be hard to get that plus the fee forgiveness as part of your EBITDA or cash flows.
Gotcha. Yeah, that's what you're talking about on the double dipping. Yep. Yeah. I agree. Uh-huh.
Yeah. Sadly, I agree with Dwayne. So.
Let's see. Janine, do you have any other questions we've got one final one here, but do you have other questions that have come up through a Q&A for folks?
Well, we had one that I missed, but because not too involved in the process, I don't know if you all have already answered it. So it is pertaining to the SBA. I'm locating it. Sorry, it's in the chat section. Jeff Wright asked it. You go ahead and ask, and we'll bring this question up in the Q&A. So carry on. Sorry about that.
All right. Well, actually, we're on some of my final thoughts here. But Dwayne, do you want to give any overall planning advice to a CFO that might be in the audience when it relates back to raising capital, and what kind of, maybe each person can comment actually on this, but really, a couple of top 1 or 2, 3 points that you make sure they're critical to know about the capital raise and planning.
Sure. Maybe just kind of summarizing some of the comments that
sure.
provided, but I just think if you're looking at raising capital, whether it's in 1 month or 6 months, I think actively engaging with prospective investors and getting to know them and educating them on your company and your potential capital needs is important. I think it's good for CFOs and management teams to understand that, as you've heard us all say, the market has largely recovered. So the concern a company or a CFO should have about the market's not right, so I'm going to be hesitant or reluctant to access the market. I would say that from our standpoint, you should not have any reluctance. The market has recovered. Maybe it's not 100% there, but it's pretty close to it. So if you have a really good need for financing, whether it's growth financing or if an owner's looking for some liquidity, I do think the market is open and there's a lot of flexibility out there in terms of type capital and types of transactions that you have any reluctance or hesitancy to access the market. And I think that like any other time period, you never know what's going to happen in the future. So if you have a really good need for capital, I'd say the risk is greater waiting for things to get better.
Good deal.
Okay, yeah, I think it faded just a little bit, but were you finished, Dwayne? Is that,
Yeah, I am sorry if I'm having
Okay.
some technical issues here.
no problem? Bill or Colt, do you have any other additional parting comments or, main facts you'd like to mention to the CFOs when it comes to raising capital that maybe hadn't been mentioned, or reiterate what we have been talking about?
I would just reiterate what Dwayne said. The the market has returned. It's very robust. You may just have to get it out of a different pocket than you're used to, but it's very competitive out there, and a lot of sources of both debt and equity. And so, just I would just encourage everybody to make sure that they know where their company is positioned, so that they access the debt or equity from the right spot.
Yeah, I think that those are the combination of Dwayne's and Bill's thoughts are spot on. I think, start early, make sure that, prepare for it, start early before you need the capital, and then understand and explore your options, because the market is good. But, individual lenders, if you isolate on an individual lender, they could have balance sheet issues. They could have, particularly, severe loan issues. And so their posture on an individual bank's, perspective may be, maybe less aggressive, but the market overall is, I would say, operating in a normal state. So.
Mm-hmm. Okay,
Perfect.
very good. That's all the questions I had at the moment. Janine, any others
Yeah.
that have come up?
Actually, yes. And to everyone, just to let you know, Dwayne did just turn off his video. So if you're hiding non-video participants, you won't see him, but he's here. So make sure you all continue with your questions. But the question that I was looking for, and with the help of one of the attendees, helped me find it. The question is, where does/should SBA funding come into play when trying to retain as much equity as possible?
Well, I will tell you, so we've not historically viewed the SBA as a source of financing. Obviously, the PPP, loans, that was a program, that came through the SBA. But that's not a source of capital that we typically navigate. So it's going to be tough for me to opine on that. I do have one client, to Bill's point. I mean, I do have one client that, is doing, and they're doing a Main Street lending transaction right now. I mean, it's closing this week. So, but that's really the only one that I've heard of, frankly, in any of the companies that we are working with. But accessing the SBA capital is, while I'm sure that it's a component of the capital that people should pursue, it's just not a market that we've gone down. I don't know, Bill, if you've got any thoughts on that.
Let me take a shot at it. I mean, the good news about an SBA financing is that it's a relatively cheap form of capital. The bad news is that, it's a government source, and they're not going to be as nimble as a private or bank source. And so, again, the PPP program was unsecured, and we haven't dealt with any lien issues there. But these EIDL loans are secured loans, liens are filed, and you have to deal with that in the financing. So you have to get well ahead of that so that you can get a subordination or a release ahead of time. Traditional SBA loans are out there as well, but they're problematic with respect to getting additional financing, because you're going to have to get a subordination or a release when you expand the financing, because they typically take an all assets pledge. So I would say that the SBA is probably not a great source if you're going to be thinking about adding some additional financing outside of that initial package that the SBA has approved.
Oops, muted. Dwayne, anything to add on that?
And I agree with everything that Cole and Bill had covered.
Perfect. All right. This is the time where all of you can really leverage this panel of experts. So if you'd like to turn on your video, unmute your line, or either or, feel free to do that. I will be able to see when you unmute your line and assume that that means that you want to ask a question. So let's start our Q&A session. And don't be shy. I feel like I need to be an auctioneer.
I'll
Janine,
start out a
Janine-
question. Any Colt, Bill, or Dwayne. So when folks are thinking about financing options, we haven't really talked maybe, everybody wants, well, you just need to find the right one. That's all you need to go to. But in reasonableness, how many, whether it's debt or equity, and it could differ, but how many options should they make to themselves? Like, in other words, candidates. Like, Colt, I'll start with you. As an investment bank, obviously you're going to always have competition. But just in general, would you suggest them going to 2, 3, 4? Is it kind of dictate from their board or their CEO? What's your suggestion there?
Sure. I think it depends on what you're trying to accomplish. I think to the extent that it's a debt financing, I think that you want, the way that we would think about that is we would want to understand what the objective of the financing is, and then think about different ways that we could achieve that objective. And let's say that there are, 3 different pockets of capital sources out there that might meet the objective either individually or as a group. And if that were the case, we would want to run a process that is competitive for each of those 3 types of capital. So in other words, we would go to, at least 10 of each, and across the country, at least 10 of each type of capital. So in that instance, that would be 30 process participants. I'll give you an example on the M&A side, because it's perhaps easier to understand the spread of offers that you're going to get out of a process. So, this deal I mentioned earlier that we got bids on just yesterday, we went out to, this was a company that was evaluating, both a majority recap with a private equity group and an outright sale to a strategic buyer. And so we went out to, a total of about 400 buyers across the country and strategic buyers internationally. And so, what came back, was, an array of offers. Okay. But the spread between the low offer and the high offer in that transaction is 100% of the deal value. Okay. So is actually more than 100%. So the low, the highest price bid, is 120% of the low bid. Okay. So to the extent that you didn't run a process, you would have missed, one or both of those groups, and you would have missed everybody in between. Okay. So, we think, having and preserving options is important, and getting a full view of the market is important.
But would you feel that a CFO or a company that's your client would say, well, Colt, maybe that's a little bit of an auction process. We don't want our deal to be auctioned and, so overly shopped in the marketplace.
Sure.
Do you ever get that kind of question or comment?
We do, until we show them the results of a bunch of other auctions, yeah. and then they see that, had that not occurred, they, somebody would have left 10 or 20 or $30 million, on the table, and usually that's enough money to get somebody's attention. And you don't have to run a process that is quite that broad. Okay. Mm-hmm. You don't, but what you want to have is, you want to have enough competitive tension that ideally, you can kind of take price out when all the dust settles and you've got your final options that you're looking at. Ideally, you can then take price out of the equation, and because you've got multiple options at a high price, at kind of up near the top of the range. And then you don't need to worry about value anymore because you've got options, and you can now choose the right partner. Okay, because you're different groups and companies have different personalities and cultures, and so ideally you can optimize life after the deal by running a proper process to get the deal done in the first place, because that gives you the ability to choose the right partner based on non-financial reasons.
Sure. Anything, Bill, or Dwayne, do you guys have that on the candidates and process, and by how many? I know in the debt side, Bill, is probably a much smaller audience, but naturally, sometimes you have to run participants with your deals if they're larger, so you got to bring some more candidates in. But what's your
Yeah, just Colt mentioned the term partner a number of times, and both on the equity end, but frankly on the debt side too. Getting the right partner for your company is just so incredibly important, because having been in a number of deals where you have the wrong partner, it's really a tough situation. It's like a bad marriage, and so making sure that you have options, and just making sure that they understand your company and you understand what their hot buttons are is extremely important. And guys like Colt's been around for so long, and he knows that market very well, and he can help lead companies to the right decision there.
The only comments I would add is that when you look at what Cole said, I agree with it. I think when you look at value, it's not just dollars. As Bill said, value can be a lot of different things. It can be structure, it can be the ability of that partner to be a partner for 10 or 20 years as opposed to 2 or 3, or it could just be the fit. So I think it's important to meet a number of different firms, because you're not just partnering with the firm, you're partnering with the individuals that are there. So you get to to see how the different groups react and respond, and make sure that not only are you getting a good valuation and a good structure, but you're getting, as Bill said, a really, really good partner. And that's that probably from my standpoint is more important than the valuation or the dollars and cents are.
I totally agree with that.
Couldn't agree more. And we've had many, we've had many clients over the years that don't take the highest price deal. They take the best overall deal. Now, now if it gets outside of too big a range, they're going to take the highest price. If there's too big a difference, they're going to eventually take the money. But I do think it's important to know that you're not. I mean, when we're kind of helping somebody decide which option they ought to take, I mean, we're looking at top line value. We're looking at structure. You could have 2 deals that are the same price theoretically, but they don't create the same value because they're different structures. And so, price, structure, probability of close, partner fit, cultural fit, financial flexibility after the transaction. I mean, there's an array of kind of elements that we encourage clients to think about, not just price, for sure.
Right.
Really great information. Gentlemen, thank you so much for such a impactful, just packed full of great advice for CFOs moving into 2021. I would encourage everybody that is on the program to snag the program handout in the chat section. There you will have their email addresses if you'd like to ask further questions. I'm sure they wouldn't mind. But gentlemen, again, thank you. John, appreciate what a great job you've done with the challenges of technology. We all experience that. And so hope that you all have a great Merry Christmas. Before we go, want to make sure that all of you return to our January 21st program, and that is on maintaining company culture in a virtual workforce, which will be a great program. We will be emailing all of you the information as it develops to register for that program. We do have a survey. It does help us know if we've hit the mark for you all CFO in the audience. So make sure you take the time to fill out that survey and share any additional program suggestions for us to do in 2021. So thank you all, gentlemen. Appreciate the time and expertise. Y'all enjoy the rest of your day.